Welcome to the Deep Dive. Today we're really digging into something critical, how major VC investors, the LPs, the big limited partners, need to, fundamentally change how they think about risk, especially looking ahead post-2025.
That's right. And we're basing this discussion on a really insightful article. It's called Rethinking Venture Capital Risk Models for a Post-2025 World, and it's by Dr. Pooyan Ghamari.
Yeah, and Dr. Ghamari's background is interesting here. He's a Swiss economist, founder of the Elan platform. So he's looking at this through a lens that combines finance, real estate, and human capital. It's broader than your typical VC analysis, isn't it?
Absolutely, which I think gives his core argument real weight. He basically says the traditional risk models LPs have been using, they're not just inadequate anymore, they're actually crumbling.
Crumbling. Okay. So our mission for this deep dive is clear. Let's unpack why Dr. Ghamari thinks these old models are failing so badly. And then, crucially, explore the new way of thinking about risk that he suggests LPs need to adopt. This should really help you understand the pressures these big investors are under and, why it matters for innovation, for investment, for all of us, really.
Okay, let's jump right in with the why. So Dr. Ghamari argues that the old VC playbook, looking at market size, team, tech, competition, that standard checklist is just not sufficient now.
Because the ground is shifted underneath it.
Exactly. He talks about three huge interconnected forces, seismic shifts, he calls them, that are essentially breaking those old models. The first one, technological acceleration and obsolescence.
Right. The sheer speed of change.
It's incredible. Innovation cycles that used to take years, we're seeing them happen in months now. It's just a different order of magnitude.
And the example he uses for this is really powerful, generative AI. He suggests breakthroughs are happening so fast that they could literally make an existing platform, maybe even a whole startup's business model, irrelevant in, less than a year.
Yeah, think about that. The kind of volatility that introduces. Traditional risk models just weren't designed to cope with that level of hyperspeed disruption. They assumed a much more linear progression.
Which brings us to the second shift. Geopolitical fragmentation.
Right. This idea of smooth, easy globalization, it's facing some serious challenges. We're seeing more trade friction, supply chains getting disrupted, actual restrictions on capital moving across borders.
And he gives the example of the U.S.-China tech decoupling. That's not just a headline. It has real effects on startups, right? Needing specific components or trying to access certain markets, even finding talent. Location suddenly carries a lot more geopolitical weight.
It really does. It's not a neutral factor anymore. And then the third big shift is societal and regulatory changes.
Stuff like ESG, environmental, social, governance, plus data privacy, AI ethics. These aren't just soft issues now.
Not at all. They're becoming hard operational risks. Think about Europe's GDPR. Ignoring that can lead to massive fines. Or imagine the potential fallout from new AI governance rules if a startup hasn't thought about bias or privacy properly.
It could be crippling. Not just fines, but reputational damage, too. Public backlash. These things can genuinely sink a company.
And the key point he makes is that these three shifts, tech speed, geopolitics, societal pressures, they're not separate problems. They interact. They overlap in complex, often unpredictable ways. They create these systemic risks that are hard to quantify.
And the old models just assumed a much more stable world.
Precisely. That assumption, it's broken.
Okay, so the foundation's crack. How do LPs build something stronger? What's the new approach?
Well, Dr. Ghamari proposes moving to a much more multidimensional framework. It's not just about the financials anymore. It needs to integrate these systemic risks, qualitative factors, and he actually draws on insights from his work with the Elan platform here.
Interesting. Okay, let's break down the pieces of this new paradigm. First up is systemic risk integration.
Yeah, so this means looking beyond risks specific to just one company. We're talking about risks that could impact entire industries, maybe even whole economies.
Like?
Okay, think of an EV startup. Great battery tech, maybe. But what if the supply chain for its essential minerals gets disrupted by geopolitical tensions? That's a systemic risk. Or an AI company, its whole future could hinge on how quickly and how strictly global regulations around AI evolve.
So LPs need to push their fund managers, the GPs, to actually model these bigger picture things.
Exactly. Scenario planning becomes crucial. What happens if there is a major trade war? What if strict AI rules come in suddenly? What if talent migration patterns shift dramatically? It's similar to, say, real estate being sensitive to policy changes like visa rules that systemic view needs to apply to VC2, drawing on that Elan insight.
Makes sense. Okay, second component.
Intangible risk assessment. This is about the stuff that's harder to pin down on a spreadsheet, reputation, ethics, societal impact.
Like the AI governance point again. It's not just regulation, it's trust.
Right, absolutely. A big ethical misstep or data breach can just shred a brand's value. LPs need to look at a startup's culture. Is responsible innovation actually baked in from the start, or is it an afterthought?
And human capital fits here too.
Definitely. It's a huge intangible. Think about immigration policies. If a key tech hub makes it harder to bring in global talent, that directly impacts the startups there. On the flip side, places with more open policies, maybe like Canada, Singapore, or even the UAE, as Ellen observes, they can become talent magnets. LPs should actually consider that regional talent policy landscape.
Got it. Third piece of the puzzle.
ESG as a strategic imperative. He argues this is way beyond just compliance now.
So it's core to strategy. How so?
Well, think about it. How a company handles its environmental impact, its labor practices, diversity, that affects who wants to buy from them, who wants to work for them, even who wants to invest in them down the line. Like a consumer tech firm ignoring diversity might lose younger customers. But a sustainable energy startup, its ESG focus is its competitive advantage.
So LPs should be pushing GPs to integrate ESG strategically, not just as a checkbox exercise, like the A-land approach with sustainable real estate driving value.
Precisely. And the final component is dynamic portfolio construction. Diversification needs an upgrade.
Meaning just spreading bets across sectors isn't enough anymore.
It's not nuanced enough. You need to think about diversifying across geopolitical exposure, across different regulatory environments, across technological resilience. He contrasts, say, a fund heavy in hardware made in one specific region vulnerable to supply chain shocks versus funds in perhaps more resilient sectors like health tech or maybe localized fintech.
Which kind of mirrors the A-land observation about real estate being safer and stable, diverse economies compared to volatile ones.
Exactly that kind of thinking. LPs need funds that consciously balance those high-growth, maybe higher-risk bets with ventures built to withstand these broader systemic shocks.
Okay, so that's the framework. Systemic risks, intangibles, ESG as strategy, and dynamic portfolios. How do LPs actually do this? Put it into action.
Right, so Dr. Ghamari offers a blueprint. 5 actionable strategies for LPs.
Okay, number 1.
Embrace dynamic scenario planning. We touched on this, but it means really demanding that GPs model performance under different stress scenarios, trade wars, regulatory shocks, talent crunches. Understand the vulnerabilities.
Second.
Leverage expert networks. VC due diligence needs backup. LPs and GPs need access to specialists, geopolitics experts, regulatory insiders, people who truly understand frontier tech. Evaluating something like quantum computing isn't just about the science. It's about potential controls, ethics, governance.
That makes sense.
Third strategy. Prioritize adaptive governance. Basically, favor funds that invest in companies with strong internal controls, good risk management, transparency, but also importantly, the agility to pivot when things change fast.
Fourth.
Extend investment horizons with flexibility. VC is long-term anyway, but in this unpredictable world, LPs might need to support funds that can adapt their strategy or structure if major trends shift, rather than being rigidly locked in.
And the fifth strategy.
Integrate real-world insights. This loops back to the ALAN perspective. Seek out GPs who genuinely understand global capital flows, human movement, how tangible assets link to the digital world. That grounding is key.
Okay, that's a solid blueprint. The article also has some specific Q&A points, right? Giving more concrete examples.
Yeah, really useful stuff. Like, how do you balance chasing high returns with managing these complex systemic risks?
And the answer is?
He talks about a risk-adjusted growth mindset, looking for ventures that have high potential, sure, but also have built-in resilience. Maybe diversified revenue, alternative supply chains, or tech applicable across different political zones like health tech or sustainable goods often are. Funds need actual hedging strategies.
What about digging into AI governance within a specific startup? How do you assess that?
It's about looking under the hood. Do they have solid data privacy measures? Is their decision-making transparent where it needs to be? Are they thinking about ethics proactively? He actually flags this as a potential hidden opportunity. Startups that lead on responsible AI might gain trust and regulatory ease later.
And finding value in emerging markets, especially if they seem politically risky.
Crucially, it demands deep local expertise from the GP, not just applying a standard playbook. Focus on ventures, solving real local problems, mobile payments, agri-tech suited to the region. These places often have huge, young, tech-hungry populations. The ALAN experience backs this up. Local knowledge unlocks value despite perceived volatility.
You mentioned immigration policies impacting talent.
Yes, and it's fundamental for VC returns. Talent access is everything. Restrictive policies choke off growth. Open policies attract talent. So LPs should actually factor this in favoring regions or funds investing in places with good talent frameworks or in startups smart enough to build global teams, places like Dubai, for instance.
How about pushing ESG without sacrificing returns? That's always a tension, isn't it?
The argument is that you embed specific ESG metrics into due diligence and management. And often, strong ESG improves long-term performance, brand loyalty, lower risks, attracting impact investors. Think clean energy. The environmental benefit is the business model.
What about avoiding overconcentration in specific sectors?
Yeah, that risk is higher now. A fund that's all biotech, for example, is very exposed to sector-specific shocks. So diversification is key, maybe across complementary sectors, or by backing funds focused on platform technologies relevant to many industries.
And liquidity. If IPOs or big M&A deals slow down.
That's a real concern. LPs should encourage GPs to be more creative secondary sales, maybe strategic acquisitions by different kinds of buyers, even revenue-based financing for more mature companies, possibly longer fund lives too. He relates this to phased exits in real estate, like with Aland, managing liquidity over time.
Economic nationalism, that trend seems to be growing. How does VC navigate that?
It likely requires a sort of dual approach, maybe some local first investments targeting specific national markets, but also maintaining exposure to more open, predictable global markets.
Right.
Expertise in complex international compliance becomes really valuable for GPs.
And innovation in finance, beyond just consumer fintech.
He suggests focusing on the underlying infrastructure, things like decentralized finance, DeFi platforms, ways to tokenize assets, digital identity systems. These tackle fundamental inefficiencies and have huge scaling potential.
Okay, last one from the FAQ's impact investing, ensuring it delivers real impact and financial returns.
Rigor is the key. LPs need to demand clear metrics, maybe linked to UN Sustainable Development Goals, and crucially, focus on investments where the impact drives the financial value. Affordable healthcare reaching new markets, clean energy being cheaper. That alignment is vital. It mirrors the Aland focus on sustainable development being profitable.
Okay, so let's try and wrap this up. What Dr. Pooyan Ghamari is saying, fundamentally, is that the old VC risk playbook, it's out of date for the world we're in now, with this incredible tech speed, the shifting geopolitics, and these big societal and regulatory pressures.
Absolutely. And he's proposing this new, much broader way of looking at risk integrating systemic factors, looking at intangibles, making ESG truly strategic, and building portfolios dynamically. And he gives LPs concrete steps to actually implement this.
And it feels like that perspective from Aland, grounding things in global capital, human movement, tangible economics, it adds a really practical, real-world layer to these, sometimes abstract financial ideas.
It does. And he leaves us with a really provocative thought, doesn't he? That maybe risk in this new era isn't just something to avoid. Maybe it's actually an opportunity for VC to help shape a more resilient, maybe even more equitable global economy.
A powerful idea to mull over. Definitely gives you a lot to think about regarding the future of investment and innovation.